So I had a subscriber reach out and tell me that he saw a video of Doug Andrew talking about infinite banking, basically being infinite banking on steroids with Index Universal Life, and how Index Universal Life was a better policy to do a banking style structure with. So in this video, what I'm going to do is I'm actually going to watch this video. I'm going to do a reaction to the video, frame by frame, step by step, to talk about, all right, hey, what's going on with this? Where is the opportunity to really have clarity about how this really works with banking style policies? And I'm going to also break down kind of some of the half truths that Doug Andrew is talking about when it comes to Index Universal Life. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's get into it. Hey, what's up, Cashflow hackers? It's Chris with Life 180. This video, we're going to be doing this review. And so what I'm going to do is I'm going to share my screen. So I'm going to pull this up, and we are going to put me in the bottom corner here. And I ultimately am just going to have this video play. I want to watch it. And as I hear things that I think are worthy of having a conversation about, I will pause it and we will get into it. So let's do this. Actually, I just watched it, full transparency. I watched a little bit of it just to get some feedback. I can't watch him in normal speed. He talks too slow for me. So I'm warning you right now, I'm putting it at least 1.25 here so we can move forward. But that is that. So, all right, here we go.
To stack up an extra $1 million. In this episode, I'm going to address how to become your own banker to make 100% returns. Get ready. It's going to blow you away.
All right. I'm ready to be blown away.
So my name's Doug Andrew, and I've been helping people optimize assets and minimize taxes, prepare for a comfortable retirement, so they will not outlive their money now for more than 48 years. But in this episode, get ready, because I'm going to give you a sneak preview right now. I'm going to talk about how to become your own banker and do what banks do to make 100% rates of return up to 500% rates of return. Yep. And then my favorite instrument, which I call the laser fund, and how that can predictably double your money probably every 7.5 years based upon my actual history of using this instrument.
Okay, so this is the first area that I'm going to really push back at Doug on this point. Is so he's saying that his history with the laser fund, which by the way is just an Index Universal Life policy. That's all it is. It's his word for it. It's his marketing phrase for it, which good for him for having a marketing phrase. But he's saying that he can double your money every 7.5 years inside of an IUL. And he says it's a very normal thing for him. That's what he just said. I'm going to tell you straight up, that is as big of a lie as it gets. Like, that does not happen on a regular basis. You cannot double your money as far as like getting 100% rate of return over a 7.5 year period on a predictable level with an IUL. And we're going to get more into this, but there is like no way that is possible. And the fact that he is selling that as an expectation when it comes to this is just, to me, like right there should be the biggest of big red flags that kind of warn you about this guy. And here's what I would say. I saw this, like looking at this video, it has 487,000 views. And all I can hope is that he was paying for some traffic, or maybe it's in like a playlist and they were pushing that off because he says this is part of a video series. So, hopefully he was pushing that and that YouTube wasn't pushing this out there, because at the end of the day, like, I can tell you, I've watched this already and it's full of so many holes and full of so many half-truths and like misleadings about how Index Universal Life really works. And he's omitting the risks, right? Like, so all he talks about when he talks about Index Universal Life is the good potential, which is all the IUL agents do in this world, is they talk about the good potential. They don't talk about where the risks are. And so that's what I'm going to do as I get through this. And ultimately, in order to do banking with life insurance and have it as a banking alternative, you need to have the guarantees and the stability, the predictability that goes along with a banking type of account. IUL does not have that, and that is the biggest problem. He likes to talk about all the upside, but doesn't want to talk about the downside when things go sideways in an IUL, which inevitably, if you plan to utilize it for income in the way that he coaches you, it's going to. And so anyway, let's get back into it, and we will go from there. Let's continue.
since 1980. And as you do that, I'm going to show you a concept of safe positive leverage, which is the ability to own and control assets with very little or none of your money tied up at risk in that asset. Leverage without liquidity is stupidity, and I'm going to explain that to you. And then by doing this, you'll be able to do what banks do. Borrow even your own money at a lower rate and continue to earn 100% or more.
I will say this. He just said leverage without liquidity is stupidity. That part I agree with 100%. You need, like, the idea of having safe leverage is a principle that I preach all the time. And that is one of the powerful parts. And one of the reasons I love whole life insurance is because of the liquidity that it provides you, but the stability and predictability it also provides you that IUL comes up short
on that money that you borrow and you use it for your business, but you will accumulate millions, not just 1 million. You do this for 15, 20, 30 years, and you will end up, like many of my clients, with over 10 million extra dollars by learning how to become your own banker. So let's start with...
I want to see many of his clients with over $10 million in their IUL policies. I could tell you, I've heard from 3 people this week alone that have dealt with Doug and then one other IUL producer who's well known in the social media space, probably even better known than Doug on TikTok. And they are dealing with situations where they were buying these IULs for retirement. And because of the fact that, they were 58 in this situation when they bought the policy, and now they're 64 and looking to retire. And they only had to fund the policy for 5 years the way that, Doug had it set up. But because of the fact that they are still in a surrender period, they were planning on utilizing it for retirement income. And now they are in really rough shape because of the fact that the surrender charges are absolutely killing their ability for liquidity in the policy. And so that's just something to take into consideration. Once again, he says he's got a bunch of people with $10 million in their IUL policy. I have a really hard time believing that personally.
The milk, and then we'll get to the meat. What do banks and credit unions do? What does the multi-trillion-dollar insurance industry do? They're the backbone of America, by the way. If you're not aware, in the Great Depression, there was a lot of real estate that dropped 80% in value. Banks closed. 40% never reopened again. The legal reserve insurance companies in the Great Depression all came through with flying colors. Not one went under in the Great Depression. It's because they have to have reserves on hand that are liquid and safe in case of a run on their institution. And so in 2008, when over 400 banks in America, because of the mortgage meltdown.
Okay, so I need to go here because this is a really, really important point. He's focusing on life insurance companies, their liquidity, the stability, the long-term history that is life insurance companies, and they are the financial backbone of the economy. I agree with that. Life insurance companies have like 80% of all mutually held whole life policies are all the cash value and all of them across the country are held by corporations and banks. So think about that. If these corporations and banks have their money in whole life, well, then that's where I want to keep my money. He's talking about IUL. Now, there's a big thing to understand the difference in the 2 different types of companies. There's a mutual company, like a participating mutually held whole life insurance company. Basically, what that means is when you have your money in a whole life policy, you're giving your money to the life insurance company. They are holding that money. They are going to be putting that money in the general fund. They're going to invest that money, and you're going to participate in the profitability of that company in accordance to how their returns do in their general fund, and then the profit centers and the profit from other products that they sell through the payment of a dividend. That is how the dividends are paid out to whole life insurance policies. Now, here's the deal. When you are a whole life policyholder with a participating mutually held company, not just a mutual company, but a participating mutually held company, and there is a difference. You are basically a shareholder with that company, and that's how you get credited those dividends. Now, with an IUL policy, like Doug sells and like he's talking about, when you buy an IUL, your money goes into the general fund, and instead of taking a dividend, they basically take your dividend, they buy options with it, and that's how you have the potential of upside in the index. Now, you are taking on more risk. Once you put your money into an IUL, you are no longer a business partner with them or a shareholder. You become a profit center for the company. That is just the way the money flows in these things. So my problem with what he's stating here is he's leaning on the history and the goodwill that the life insurance industry has been built upon based on the history and success of participating mutually held companies. And Index Universal Life is basically from 1997, that's when it was created. UL, traditional UL, as he talks about in his Laser Fund book, was created by E.F. Hutton in the early 80s. And so when you look at that, I encourage everybody watching this video, go do a Google search on the history of traditional universal life. And it's not pretty. And you look at the way these insurance companies handled those policies and the policies that were lapsing and all the problems. And I don't know much about this, but Doug has been doing this a long time. My guess is he probably sold those UL policies and then pivoted to IUL when IUL was released in 1997. I can't say that very specifically. Like I didn't know him back then, but the people that sold UL are the kinds of people that are going to continue to sell IUL. IUL is just a failing financial experiment by these institutions. They are simply a UL product, the product that failed. And instead of taking the fixed crediting strategy, they take that fixed crediting strategy and they buy options with it. That's all they're doing. And if you understand how they're buying options, they're not getting massive returns with options. They're simply getting, utilizing the options as a hedging strategy. So it has a little more upside potential. That's where the idea of upside potential and downside protection came from. Traditional UL, the ability to buy options gives a little more upside potential. That's it. And so the challenge is now there have been some situations where uncapped indexes have come out, and he's going to allude to something, and I'll talk about that actually in a second, because he's going to allude to the fact that he's had clients earn 60% in a year. Like, okay, he's like cherry picking one perfect scenario of point-to-point results for specific IULs where they can earn that in one scenario, but it's a unicorn situation. I don't care about unicorn situations. I care about if you are buying this product to solve a problem in retirement for retirement income. I care about how's it going to perform over the lifetime of the policy, and how's it going to perform for the use case in which I want to use it during retirement. Let's talk about that. Now, getting back to the banking concept, getting back to the banking policy concept, when he's talking about 2008 banks were failing, like all these things, and the fact that during the Great Depressions, banks failed and life insurance companies were stable. IUL companies didn't even exist in 1929 when these banks were failing. It was whole life insurance companies. In 2008, I got news for you. If you had an IUL, they became popularized in 2009. That's even though they were created in 1997, they had no market share until 2009 because people started selling this story of upside potential, downside protection with a 0% floor. But it was still the wild, wild west, and policies have been performing worse and worse and worse since then. Go look at the regulations. Go look at regulation AG49, AG49A, AG49B, and see how this has been going. Those are regulations that have been created to counter all the misleading illustration tactics that companies have been putting out there, that people like Doug have been, that have been like just basically trailblazing this idea, this concept that is basically smoke and mirrors, and it's a pipe dream on it actually performing. And that's the thing. That's why I created the IUL challenge. And I'm telling you, like, it's not that IULs cannot perform. It's that if you sold 100 policies, 5 of them might perform. So if you're putting your livelihood into an IUL policy and you are needing that policy to be there to do all the things that you're relying on it for in retirement, are you willing to get on that plane? Are you willing to put all your hard-earned money into a policy that has, let's say it had a 30% chance of failure? That's it. I'm telling you, I believe it's a 95% chance it's not going to succeed. What if it was only 30% chance it wasn't going to succeed? Would you put your money there? And the problem is he's using whole life's historical success and foundation and stability as for the participating mutual companies as the benchmark of success and allowing IUL to borrow that credibility. IUL has nothing to do with that. And I got news for you. If the market goes down, your success in an IUL has nothing to do with that, right? Because you become a profit center to the company. If you have an IUL with a company that has a whole life policy and an IUL, they can up your fees and charges and everything with an IUL to meet the guarantees and support all the dividend earning whole life policy holders, right? Like that's the way these things work. So it's important to understand all the internal workings above and beyond the illustration, because at the end of the day, these illustrations for both whole life and IULs don't matter. And that's coming from somebody who believes wildly in whole life insurance. So important to understand. Hopefully that makes sense. Let's continue this fun stuff here. Let's go.
If you remember this, there were 400 banks in America that went under. 900 more were on the brink. It's called the watch list of going under. The federal government was concerned. Now, a lot of Americans don't realize how close we came to a total financial collapse in 2008. So the federal government asked the 5 major banks in America to disclose where they had their tier 1 assets for liquidity and safety. Guess where they had it? In insurance companies. And these insurance companies maybe just credited them.
Yeah, in insurance companies with participating mutual companies where they were the business partner, not the profit center. They're not utilizing IUL for these products.
4 or 5%. This was in 2008. So let me tell you what was happening. Banks in 2008 were borrowing OPM, other people's money. Meaning, when we put money into a bank or a credit union, it's in a lended position. Are they just a benevolent institution paying us interest? No. They're loaning it back. They are investing it. But
I think that's important for people to understand. When you put money into a bank, he is right. Like your deposits in a bank are not actually an asset for the bank. They are a liability for the bank. And I think a lot of people don't understand that, because they are obligated to give you that money at any point in time. And this is in the world of fractional reserve banking. That's where the system kind of falls apart, because they are over leveraged. And this is where bank failures come from, because when they get over leveraged and deposits slow down, and then they're not getting the deposits in to basically meet the needs of the withdrawals that are taken. That's where runs on banks happen. And that's why I basically call the banking system a Ponzi scheme. Because if they're not getting enough new deposits, when you look at the bank failures that have happened this year, in 2 of the cases, it straight up said the reason the bank failed is because new deposits slowed down. And so if the banking system requires new deposits for the system to remain solvent, that is by definition a Ponzi scheme. If you need new money to come in to pay out old people, that is a Ponzi scheme. So the banking system is a Ponzi scheme. So anyway, I just wanted to kind of back him up on that point. Once again, there's a problem with me and Doug. It's like, I agree with a lot of what he says. It's the principle and how he tries to angle people and what the solution is that to me is the biggest problem.
Said that we put 30 to 40% of it for liquidity and safety into insurance companies. They're bigger, they're stronger. See, some of these insurance companies where I have my money manage trillions of dollars. In fact, one has as much money as the IRS collects in taxes in an entire year, and that's just one insurance company. This is where many governments go to for help when they need it, is to the multi-trillion-dollar insurance industry. So I just bypass the bank, put my money where the banks put it. But what were the banks doing? They were paying, let's say, 1%. Now, 1%. Every million they borrow at 1% interest, or that they pay 1% interest to us, on an annual basis, they're only paying out 10 grand. They turn around and put that million in insurance companies and earn 5. That's what they were doing in 2008. How much more is 5 than 1? Don't say 4. It's 500%. It's 5 times. They were paying 10 grand and they were earning 50,000 on that money.
That's fair. I mean, he's talking semantics. It's like, if you were to buy a real estate property and you put 50,000 down on the real estate investment, and it was a $300,000 property, and then you sold the property for 50,000 more, so for 350,000 a year later, then what was your rate of return? It's not 50,000 above the 300,000. It's 50,000 on the 50,000 that you invested from a cash in, cash out perspective. So you had 100% rate of return. So when you look at it from the banking system perspective, it's called arbitrage. And this is where a lot of agents overuse this concept and phrase, is the fact that, like, when you talk about arbitrage, most banks are, and right now, I mean, this is about a year ago he filmed this. He's using numbers that are much smaller than today because rates have gone up. But at the end of the day, if a bank is paying you 2% and then they're able to take that money and earn 4%, well, then they got 100% rate of return on their money. And that is the way it is. And that's where Nelson Nash and the infinite banking concept, and just the idea in general of focusing more on volume than rate of return is super important. And when we find the right opportunities and we focus on the right financial structure, that's the important stuff that we're talking about. And that kind of understanding how that money how you have the ability to actually capitalize on the kinds of returns that banks do, that's where the infinite banking concept comes in. And when he talks about becoming your own bank in this way, utilizing IUL, he's basically bastardizing the whole concept by utilizing the IUL as a product to execute on this. So, all right, let's go.
Would you hire an employee for 10 grand that may do an extra 50 grand? Would you buy a widget machine for 10 grand that may do an extra 50 grand? You bet. That's called a 500% return on employment cost or equipment cost. Business owners get this. So that's what banks and credit unions do. Now you can become your own banker. So my favorite instrument where I bank my own money is in a max-funded indexed universal life insurance contract. And in other episodes on this channel, I talk about how to take the least amount of insurance the IRS will let you get away with and put in the most money the IRS allows, and it turns into a tax-free cash cow.
So that, by the way, is good philosophy for any life insurance contract, whole life insurance, IUL. If you're going to buy them, that's pretty much what you want to do, no matter what. The fact is, a lot of agents don't realize you could do it the same with whole life as you can with IUL, as far as the minimum death benefit, maximum cash value, really designing the policy for high liquidity. Because of the lack of surrender charges in whole life is actually more liquid. The guarantees are better. So from a banking perspective, it's better. It's a better volatility buffer. He talks about this later, but whole life is a much more stable asset. Now, I know a lot of IUL agents are going to sit here and tell me, oh, well, you can use a rider to eliminate the surrender charges in IULs. Well, yeah, that's true. And you could do that, but that comes at a cost. And there are fees to that really negate long-term performance and have a negative impact on long-term performance. And so that's something to take into consideration. Either way, I think to be able to say that, you're going to be able to use an IUL to predictably do any of this stuff is just a flat out lie, because, at the end of the day, if you do what he suggests in taking an index loan and be able to pay, he uses smaller numbers in this. He says you're going to pay the insurance company 2%. Well, right now it's 4.5% or 5% probably. If you're going to pay 5%, he's going to say, well, if you could pay 5% and earn 8% or 10%, well, then why not pay the 5, earn the 10, borrow against it, and ultimately you're going to earn that 100% return on your money. That's the equivalent of doing it. But what he doesn't talk about is the fact that on years, which 40% of the time, the market's going to produce worse than the 5%, on those 40% of the years, you actually pick up additional costs and risks, which if in retirement, you have loans out against the policy as you're getting older, it is a recipe for disaster. That's why I call these things financial suicide, because it is just atrocious.
Where I have averaged, I earn 11 and I net 10. I've actually earned an average of 9.62% on my, I call them laser funds, ever since I began owning them clear back in 1980. Now, before I go...
He hasn't owned these since 1980. That's just a bunch of garbage. The IULs haven't even been around since 1997, and he hasn't called it a laser fund. And, he, at the beginning of this, I should have said this then. He mentioned that this is his 11th book, Laser Fund. I dare anybody watching this video to go Google Doug Andrew lawsuit, Doug Andrew misfortune lawsuit, Doug Andrew, go pick the title of his book and write about it. And there's been lawsuits and after lawsuit after lawsuit for a lot of the books and for many of the situations. And so, I don't know, I just do your own due diligence. Don't take my word for it. Go Google him and do your own search. And that's the mind numbing part to me, that people all these people are following this guy, and, just doing a simple Google search will tell you everything you need to know about how this is really going to turn out for you.
Any further, if this is already arousing that curiosity, be sure and post a comment, click like, share it with somebody, but subscribe to this channel. It's free, and I post a new education
or share my video, but not his.
So here we go. Let's say that you get it, and you begin to sock away money. In other episodes on how to stack up $1 million, I talk about just.
I'm sorry, guys. I gotta do this. I have to make it go faster. I cannot listen to him in this speed. It's just too much for me.
Systematic accumulation. You could sock away $5,000 a month for 120 months and you'll have $1 million tax-free in the laser fund. Let's say you put in $250,000 and then added a $2,000 a month and you did that for 10 years, you'll end up with $1 million. You can rent out an apartment on Airbnb for $7,000 a month, which is $350 a night, and your mortgage might be, or your rent might be $2,000. You sock away that $5,000, you're going to end up with $1 million. So let's take that snapshot in time, because I have many clients that I've mentored that end up with at least $1 million or more. So far so good. So let's take that snapshot in time. You now have $1 million in your laser fund, your max funded IUL. Now here's what savvy, smart business owners do. They operate as their own bank. Now listen very.
So if you operate as your own bank and you borrow against it and you do like an Airbnb, in which, by the way, I wrote a book called Cashflow Hacking, and I'm really big on real estate investing and utilizing whole life insurance for real estate investing, because of the fact that we want to utilize the asset that we're utilizing to fund our real estate investments. We want to be stable and predictable. By utilizing an IUL, you're injecting more risk into the equation. So if the market goes down, you actually have more expenses and more inefficiency and more stress, which is the opposite of what you want in times of hardship. I always say, you know, one of the greatest kind of half-truths of IULs, they say you can't lose money due to market loss. But I got news for you. You can lose money because of market loss, because when you have loans and all, you know, I guess loans and expenses out on your policy, when the market loses money, you don't earn more crediting. You pick up an extra interest expense that then starts to compound against you. That increases your net amount at risk. It increases your fees and charges. And ultimately in retirement, or even before retirement, it becomes an additional financial stressor on you. That's why these things always look good on paper, because they assume and show you that it's going to be positive every single year, when in fact, like I said before, 40% of the time, it's going to be negative.
Be close. Stay with me here. You have $1 million and now you see an opportunity. Now, I have many clients that invest in real estate. So I'm going to use an example of one of my clients that his specialty is to find multi-unit apartment complexes that the seller just wants out. They're tired of being a landlord, fixing toilets, evicting tenants, and so forth. And they don't want to even fix up the property. They just want to liquidate it. So he finds those properties and he buys them and he fixes them up, and then he turns around and flips them. He doesn't like to be a landlord himself either. So just like somebody that buys and flips houses by fixing them up, he buys big apartment complexes and fixes them up and then flips them, because he has a pool of investors that want to buy apartment complexes that are fixed up and have good cash flow. So far so good. He comes across one and it could be, golly, 10 million, 15, 20 million. Many times he needs an earnest money. So he will call me up and he'll say, Doug, I need $1 million to tie up this piece of property. Send me over that form. Now it's one page. I email it to him. And he has his laser fund, his IUL policy. And he puts his name and his policy number, which is like an account number. And then it says, would you like to withdraw $1 million out of your policy, or would you like to borrow? What do you think he does? Yeah, he's smart. He borrows. See, if he
So from that perspective, I mean, yeah, you in that scenario, you'd always want to borrow. Once again, borrowing against your IUL is injecting more risk into that equation. Depending on what his time frame is on paying that loan back, will dictate how much risk he's actually taking. What the market is doing, what the market environment is, also plays into the equation. You know, the idea of being able to pull out a wash loan, a lot of people say, oh, he'll just do a wash loan, so there is no risk. Well, there is risk, because the net amount at risk is not getting compressed. And that's how it's showing on the illustration, is the net amount at risk is getting compressed. And therefore the cost of insurance and all the admin fees and all that stuff is shrinking as you get older. And so if you use the wash loans, you're not compressing that net amount at risk. So all the costs and the fees in the policy that they ran with index loan assumptions being positive every year are going against you. And this is why I always say that people, like, my biggest problem with IUL is it's a very complicated product sold as a very simplistic solution. And it's full of half-truths and a bunch of marketing gimmicks like the laser fund.
Withdrew the $1 million. Now he doesn't have the $1 million in his policy earning interest. That's okay. You can do that. He doesn't have to pay tax when he withdraws it, but he is a business owner. He's savvy. So he borrows, and people go, why would he borrow his own money?
He's not borrowing his own money. And this is actually, I'm going to let him play this out.
There's two ways he can borrow. The first way is called a zero wash or zero cost loan. He can tell the insurance company, you know, I think we're headed for a recession, so I will borrow $1 million, and in order for it to be tax-free, the insurance company has to charge him at least a nominal interest rate. So that might be 2%. So the insurance company is charging him 2% a year, which is 20 grand, but he doesn't have to write out a check for 20,000. That loan is not due and payable during his lifetime because the insurance company is crediting on that collateral, that million in the policy, the same 2%.
So here's what happens though. Throughout the life of his policy, he'll pay 2, earn 2, but because it's not compressing the net amount at risk as he gets older, because it's an annual renewable term chassis, the cost of insurance is going to wind up compounding against it, and it will wind up causing a lot of problems in the policy over time. And obviously, if then he gets to retirement and he wants to use it for tax-free income, like a lot of Doug's clients do, and a lot of IUL clients do, they focus on tax-free income. Wash loans are a recipe for disaster because of that reason as well. And so at the end of the day, you're kind of damned if you do, damned if you don't, whether you do that or the index loan. And we'll see what he has to say about the index loan, I'm sure now.
So he borrows it to, they credit to, it's a zero wash loan. It doesn't cost him anything to call it a loan. And that's what qualifies the million to be tax-free. But he's savvy. Usually he will use the index loan like I did. Now, what's an index loan? By the way, if this is going, wow, be sure and subscribe to this channel. This is just the tip of the iceberg, folks. So he goes for the index loan, which means, okay, you can charge me 4% or 5% of my million. Why would you want to pay 4 or 5% to borrow a million out of your policy when you could just be charged 2? Because
it's so please, this is another thing. You are not borrowing a million out of your policy. You are borrowing a million against your policy. It's leverage. You are utilizing the cash value in your policy as collateral to get a loan from the insurance company. One of the reasons that I love whole life insurance is you can do the same thing. And one of the reasons that, and if you want to understand where's the risk in this, well, go look at banks. This is my encouragement to everybody to like vet out, like, do these loans make sense? Well, to me, banks make good deals, right? Like that's what banks do. They know how to find good opportunities, and that's what banks do. They know how to find good opportunities, good investments, all the things he was just talking about. So go look up the concept insurance-backed line of credit, and go look at all the banks that offer insurance-backed lines of credit. And what you're going to find is that most companies, most banks that offer insurance-backed line of credits will only do it for whole life insurance, because whole life insurance is predictable. It's guaranteed. They know it's going to be there. With IUL, there are a couple companies now that will offer insurance-backed lines of credit for IUL. However, the amount, like with a whole life policy, I know of companies that will give you 100% loan to value ratio. They'll say, hey, rather than use a policy loan through your insurance company, just do a collateral assignment of the cash value inside of the policy, give it to us. We'll give you up to 100% line of credit up to the cash value that you have in your policy. And a couple companies will do that now for IUL. However, they will not give you the 100% liquidity. They will only give you 70, 75, maybe 60% on the cash value line of credit. So if you have $100,000, they maybe give you $70,000 for a line of credit according to that. Why? Because they understand that there's a lot more risk, and that's not an inconsequential number. And the fact that most banks still will not offer insurance-backed lines of credit through a bank, that should tell you that if a bank's not willing to do it, talking about utilizing and becoming your own bank, if a bank's not willing to do this for you, you shouldn't be willing to do this for yourself. You shouldn't do this to yourself, is what I would say. So anyway, that is that. Hopefully that makes sense to you. And I would encourage everybody to Google insurance-backed line of credit. I've got a couple of videos out on that. You can go check them out if you want.
The million that is still in your policy because you didn't withdraw it. Yeah, it's just semantics. You're borrowing by having your million as collateral. And now you're saying, okay, you can charge me 5%. He did this in 2017. He borrowed $1 million out and they charged him 5%. What's 5% on $1 million? That's 50 grand. He didn't have to write out a check for 50 grand because they credited him the indexed rate that year.
But if you lost on the indexed rate, if the market did zero, he would have an extra $50,000 expense. So he's just talking about the pie in the sky pipe dream. 40% of the time, you're going to have more of an expense than the credit, meaning the credit you earn is going to be less than the actual amount you are credited in the policy. So it's really important to understand that. And when you have a negative year, meaning you're earning fewer credits in the policy than the interest expense, then it increases the costs and the charges and the fees in the policy, which compound against you, which ends up making it ultimately come off the rails. And that's where they come into problems.
on the million that he left in the policy. Guess what he earned in 2017? He capped out on his universal life at 25%. 25% on a million was 250 grand. Are you with me? They deducted 50,000 out of the 250,000.
Okay, once he's talking about these uncapped indexes, which, yes, in a vacuum have the ability to do that. I mean, I've seen a couple of these things earn 60% in very small windows, point to point, when we were at the very bottom during the COVID crash. And then during the high, when it hit the recovery a year later, when it hit the peak, it was like a perfect scenario. A lot of these IUL agents are using that time frame, that time period, as examples of how amazing these policies are and how good they can do. These point-to-point indexes that they're using, you're talking about, like, that's a unicorn situation, and that's not something that could be like depended upon or relied upon. It's not predictable, and it's not something that is actually going to be something that you can expect the policy to do. And once again, I don't care what it can do for a single year. I care about how all the moving parts of this policy function over the lifetime of the policy based on all the different ways I want to use a policy. And these are the things. He's really good at marketing. He's really good at getting you to focus on these little hype issues and the clickbait stuff. But ultimately,
he netted $200,000 of growth on the million in his policy, tax-free. He netted 20% return tax-free on his policy while he was using the million to acquire an apartment complex that he fixed up and he sold, and he made 2 or 3 million. Is this blowing you away?
No.
This is how many savvy people accumulate millions of extra dollars by accumulating.
This is how a lot of people buy into this, is by listening to this garbage, and then they wind up calling people like me to help them back out of it. I can't tell you how many people I've helped get out of these IUL policies that were horrible, that, ended up in the lawsuit and ended up having to get the company to refund their money after they spent, $10,000 to $20,000 on legal fees dealing with the insurance company. And then eventually the insurance company just gives you a refund. It's a pain in the butt to deal with, but you can do it if you're in that situation.
In a laser fund tax-free, and then becoming their own banker and borrowing money. I don't care if you borrow money at 5 and you earn 10. How much more is 10 than 5? 100%. Would you hire an employee for 50 grand that made you an extra 100 grand? I'd do that all day long. That's actually been the average, is earning 100% more than the cost of borrowing out of a max funded IUL.
That is just, no, that is not the average. That's just, not on a net basis. Like, come on, Doug. That, like, after surrender charges and after actual cost of insurance and all the fees, like, let's be real.
Years you may not. Other years you may make 25%. As of the recording of this episode, last year in 2021, we had clients on their Index Universal Life lock-in gains of 61.33%.
That's what I was talking about. That 61.33%. That is the bottom of COVID and the top of the market recovery. The year later, that point-to-point number. Go look it up. Just it's crazy.
So let me just give you one other little aha here. Let's say you borrowed $1 million out of an IUL policy at 5%, and you could earn 10%. But what do you do with $1 million? Let's say you go out and buy 5 rental properties, and you only pay 20% down on each of those. So the rental properties now are being rented out for double what the interest payment is being charged. So you got this positive cash flow, and you're getting some tax breaks because you're able to do that. Or maybe you went to a mortgage company and borrowed it. You can leverage safely but maintain liquidity by putting it into the IUL. So you can take that and pay it back into the IUL policy, and you can actually end up putting money back into where over just a period of 10 years or so, you can end up with an extra $5.75 million by borrowing on your IUL, leveraging safely on property, and then taking the cash flow, putting it back into the IUL, and you're still earning money on the original.
Please don't do this, guys. Please don't listen to him. If you want to leverage your money for real estate and you want to do this, whole life insurance is where it's at. And like a lot of the most successful people in the world that are doing this, these IUL agents, once again, have stolen the success and the track record and the history that whole life has built up and done successfully for these strategies. And they're trying to twist the conversation and make it look like that IUL is whole life 2.0, and it's like an enhanced, an improved version of whole life insurance. I've even heard some people say, well, whole life is a flip phone and IUL is a smartphone. And like, nothing could be further from the truth. Nothing could be further from the truth. And this is just smoke and mirrors and it illustrates really well, but it's never going to perform according to the illustration. That is why, and when I say never, I'm going to put a caveat to this. I mean, 95% of the time, it's not going to perform according to the illustration. And so something to take into consideration.
Balance that was in there because you leveraged on your IUL. If your brain is going, whoa, you need to read my book. So here's how you can claim your free copy. This is book.
And by the way, that book, I did a book review on that book. I've got a playlist going, reviewing that book and breaking it down. So if you want to kind of save yourself the time and the trouble, go check it out.
Number 11, and it's been flying off of our warehouse shelves. It's 300 pages. It's called the Laser Fund. Laser is an acronym that stands for Liquid Asset Safely Earning Returns. This will teach you how to diversify and create the foundation for a tax-free retirement. And you'll learn in here and on this channel how you can accumulate an extra $1 million.
All right. So the rest of the video, all he's doing is he's selling. You know, it really is sad to me that this video has 487,000 views. The thing that I see in that is just, I just count the people that have been hurt, that are in bad financial position because of this. I've had conversations with 3 people this week alone that have put over $1.5 million into IULs, and because of surrender charges. And one of them was a Doug client. One of them was a Curtis Ray client, and one of them was somebody else completely. But I've put over $1 million to $1.5 million. And the best case scenario is they had $600,000 liquid after 7 years. That was the best case scenario. And now there's different reasons with policy designs, and they all could have been done a little better, a little differently. And so I know I'm going to have agents that are like, oh, it's a policy design issue. Well, one of the guys who's arguing with me on the channel about it the most says like Doug is his mentor and he understands how to do this stuff, and it's the bad agents. Well, one of these clients was a Doug client. Like, so, you know, we're dealing with this stuff all the time. And I deal with people that have put tons of money into this because they buy videos like this. They get into it. It looks really good on paper. So people's mindsets are, well, if it shows on paper that way, why would an insurance company lie to me? I'm going to encourage you to do 2 things. Go do research on the history of traditional universal life, because all the companies that were selling them and more are now selling the index universal life. Watch how the companies treated their policyholders for the ULs. And if you believe history has a habit of repeating itself, I think what you'll see is, you know, it's a pretty clear story. You know, so I think that's really important for people to understand and for people to contemplate. And, you know, I don't know. I had something else that I was going to say, or I thought about, but I forgot what I was saying. And the other thing is, I would just say, you know, just go into the Google and do a search and see what's going on. Actually, let's do this. All right. So what I want to do is one little thing here. I want to do this. I want to kind of go this route, and I'm going to show my screen. Let's see here if I can do this here. What I want to do is I want to show this real quick, and you can see here what I did was I just typed in Doug Andrew lawsuit. Right. So radio financial guru sued for $428,000. Doug, there's my video. I got an exposed video on him that kind of goes through some details. Paramount Financial Services, SEC. The SEC has a site on him. He received $1.8 million in transaction-based commissions from Woodbridge, which ended up being a Ponzi scheme. So him and his crew were basically having their clients put their money in a Ponzi scheme. So, you know, that's something. Beware of the missed fortune sales concept, certified financial group. Eddie Cressy, it's a legal thing. Banned from selling securities, but still hawking insurance. This is investment news, this is a big one. This is about Doug's family, Doug's son. You know, it's something to be considered. You could see here, Utah Gov, Douglas Andrew, listed as sole principal, Live Abundant. You can, like, once again, I'm not going to get into this, but administrative complaints in the state of Idaho, we saw Utah complaints. You know, it's at FIPlawsuit.com. SEC announces lawsuit charges. Like, once again, I'm looking at this. I don't know what this is. Wait, what is this? I haven't seen this one before. Now I'm curious. I am curious what this is. Court of California, Penn Mutual. George Harvey and Linda Harvey. Penn Mutual Pennsylvania company, Paramount Financial Services, Utah, and Live Abundant. Yep. So once again, I don't know if Doug was actually named in this or if it was his company, but either way, I'm not going to get into all this. I just encourage everybody, you should never put your money in anything you don't understand. I'm a really, really huge fan of whole life insurance. I'm a huge fan of cash value life insurance for all of the reasons that he states in trying to go around the system. The problem is the solution that he uses in Index Universal Life is bastardizing the concept. He's using a failing financial experiment to be able to do it. A failing financial experiment that's been failing since 1980 when UL failed, and then they tried to do IUL. IUL's been failing ever since, underperforming. It's why I created the IUL challenge. Go search hashtag IUL challenge. Tell me how that works, and tell me the content that you find, and tell me what people's responses have been. That just is what it is. And so anyway, hopefully you found value in this. If you did, comment in the comment section below. Share this with people if you know anybody that is thinking that they can utilize infinite banking with an Index Universal Life policy, because they can't. And I know there are hundreds of thousands of IUL agents following Doug Andrews' teachings that to me are extremely dangerous. So anyway, have a blessed and inspirational day. Hopefully you found value in this. Feel free to reach out if you need anything. Take care.